Welcome back, everyone. Today on the Joseph Carlson Show, around the end of every year, I try to look at different companies and assess whether I want to own them for the new year. It's a way of kind of refreshing the portfolio. We like to look over our portfolio and make sure it's as good as can be. In this case, we're going to be looking at the valuation of some of the most popular stocks in the market. I've outlined 12 different companies. 12 of the most popular stocks based on Qualtrics usage analytics. These are the companies that you guys are looking at, that you guys are researching. We're going to be going over all of them, and I'll be giving my opinion on their current valuation based off of discounted cash flow analysis. That's right, for each company, we'll be opening up the discounted cash flow calculator. We'll be plugging in some assumptions. We'll be arriving at a current valuation and then charting it on to a tier ranking list. At the very top, we have the most undervalued companies that are so undervalued that they're basically in the trash bin. Investors have thrown them away. They don't want to own these companies. They don't want to pay anything for them. That's how low the valuation is. Then we have companies that are merely dislocated. We have fair value companies. We have premium valued companies. And then at the very bottom, we have the highest valued companies in the market. These are the ones that are straight up cult status. So we'll be going through each of the 14 companies, running the DCF calculations, and I'll be putting them where they belong. Now, we also have a lot of other news to get to. For example, Paramount is now doing a hostile takeover bid of the Warner Brothers Discovery assets. No longer is David Ellison talking with the Warner Brothers Discovery management team. He's done doing that. Now he's going straight to shareholders saying that his bid is better than Netflix's, that he can get the deal done. He's going on to TV trying to sell this deal, saying that it's better for the investors, it's better for Warner Brothers Discovery, it has a higher chance of passing regulation. What does it mean for Netflix if they're not able to buy Warner Brothers Discovery? We'll be looking at that as well. And then, of course, we have the fail of the week, which we kick it off this week with a new story about Waymo. And in this case, it was an unfortunate event where a Waymo vehicle ran over a cat. The cat happened to be like this very popular cat called Kitkat. A lot of people are upset about this, including the New York Times, which did multiple in-depth research analysis on this cat being ran over. There's like black and white footage of it. There's in-depth analysis and articles being written about this cat's death, the role of the cat, what the cat accomplished throughout its life. This has taken a life of its own, where now a California supervisor, an elected official, is calling for hearings about the Waymo and the cat, trying to get people's attention and not letting this story die. Because after all, this is the most important thing going on in the world, is the death of Kitkat. We'll be going over this in the fail of the week. So we have a ton to get to in this episode, lots to go over, and just a quick reminder, if you haven't tried out Qualtrim.com, I believe you're missing out. We've literally had thousands of new people try this software out just in the past couple of weeks. In fact, this is straight from our dashboard. We've had 2,500 people join in the past 4 weeks alone, and that's after the free trial. So these are people that have decided to join even after a 7-day free trial. That's because when you try it out, you'll fall in love. Qualtrim is a fully fledged stock analysis platform. It has long-term financial history. Everything is visually illustrated. It has in-depth watch lists. It has the dip finder. It has portfolio analysis tools. It has transcript summaries of earnings reports, and it has a discounted cash flow calculator that we'll be using today. You can try out Qualtrim right now at Qualtrim.com. If you go there and you check the monthly plan, it comes with a 7-day free trial, so you can join now at no risk. Now let's go ahead and jump in. Like I said, we're gonna be going over a DCF calculation of all the most popular stocks, and today we're gonna be starting off with Mastercard. This has become one of the more popular stocks in the community, obviously because I've made it a central buy over the past couple of weeks. To me, Mastercard represents a great combination, okay? I'm looking for a lot of things when I buy a stock. I'm not only looking for a decent valuation, something that I feel like I'm getting more than what I'm paying, but I'm also looking for stability. I'm looking for robust moat. I'm looking for very long-term survivability of the stock. I don't want it to be disrupted or go down. So when I'm looking at all these different factors, good valuation, big moat, a stock that really can grow organically for a long period of time, and one that I can make a centerpiece of the portfolio, Mastercard checks a lot of boxes. When we look at the free cash flow, we're looking at the free cash flow on a per share basis. This is what Dev Kantasaria says is the best estimate of the intrinsic value of a company, is their free cash flow per share growth over time. Meaning that as the free cash flow per share grows, so does the intrinsic value of a company. Now, how does Mastercard grow its free cash flow per share? It all starts with organic top line growth. When you have a company that's growing like this one, It's growing 15 to 16% organically. Right there, that gives you a lot to work with. Another thing that I look for to determine the capital efficiency is I look at the stock-based comp of the company and I adjust that for the free cash flow. When we look at that, we have the stock-based comp in blue there. We have in orange the free cash flow. You'll notice that the stock-based comp is a tiny fraction of the free cash flow, meaning that this is not a company that dilutes the shareholder. They give all the shares to the employees, and then they use their free cash flow to buy back those shares that they just gave away. A lot of companies do that. Mastercard does not. Then finally, when we look at the free cash flow per share growth over time, with all these factors, the fact that they don't dilute the shareholder, the fact that they're growing revenue organically very fast, the fact that they don't have a lot of expenses inherent in the business, so they have operating leverage, meaning the revenue grows faster than their expenses, all of that combines to an incredibly fast free cash flow per share growth rate, one exceeding 30%. So again, if free cash flow per share is the best measure of intrinsic value of a stock, Mastercard is a company growing that intrinsic value much faster than most companies. Then if you believe the moat is intact, that's a whole different argument, but if you believe that's the case, this looks like a very strong company. When I put this into the DCF calculations here, we have one right here that I've pre-filled. I have Mastercard growing at around 20% per year. So this is the free cash flow per share with a yield that I believe is around 3%. I believe that's the fair free cash flow yield. Another way of looking at this is using multiples. So a 3% free cash flow yield is the exact same as a 33.3 multiple. So this is paying 33 times free cash flow, which is in the more premium category, but it's not crazy. It's not crazy for a company like Mastercard. In fact, I think it's warranted. I think Mastercard will trade between that 3, maybe 3.5, maybe 2.7. And either way, from today, if it trades at a 2.7, you get a 26% return. If it trades at a 3% free cash flow yield, and it's growing at 20% per year for the next 5 years, you get a 24% compounded growth rate. What investors have to have happen for Mastercard to be a bad buy is for the growth rate to suddenly go way down, to go down to like 13%, and the free cash flow yield to go up. So you have to have multiple compression and you have to have growth deceleration. And I don't believe that that's going to happen to this extent. Even when you do have that happen, the return is still positive at 10%. Mastercard's not in the trash bin. It's not a company that investors aren't paying for right now, but I do believe that it's dislocated. Mastercard is a dislocated company, a high quality one that's trading at a low valuation. It's worked its way there over the past couple of years. And I believe the earnings growth of the company, combined with a stable and in fact increasing multiple, should make this company be an attractive buy. Next up, we have Meta. This is one of the most popular stocks being researched right now, and for good reason. Meta is an incredible company. It's traded recently at a small dip. Not anything huge. It dipped down a little bit down below $600 per share. A lot of investors jumped on that. And when we look at Meta, there's one issue. I'll highlight the issue going in and how Mark Zuckerberg is solving this. So we have the free cash flow of the company. We look at the past 10 years here. If we look at the stock-based comp compared to the free cash flow, this is the big question for Meta. We can zoom in a little bit there. Notice how the free cash flow is going down from 54 billion to 44, and the stock-based comp went from 16, 17 billion dollars to now almost 19. Right now, Meta's stock-based compensation makes up a staggering 42% of their free cash flow. So Meta's doing the exact thing that I don't like companies to do, where they issue a ton of stock to the employees. Then they use their free cash flow to buy back that stock so it doesn't dilute the shareholders. So basically, the way that I look at this is you may as well subtract that stock out from the cash flow because all they're doing is issuing the stock, buying it back with their cash flow. You net it out either way. When you look at the free cash flow per share, it looks much lower because of that stock-based comp. So I look at Meta today and I make a few assumptions. When we look at the DCF calculator, we can plug in a couple, I think, very good assumptions, very realistic ones. We can, for example, say that they're going to grow their free cash flow per share at around 18% over the next 5 years. Meta can easily do this. In fact, they could surpass this if they just cut down on their employee expenses a little and they cut down on their CapEx. He can take his foot off the gas anytime on CapEx. That'll make the free cash flow per share grow. It'll make it grow very fast. Then we can say that Even if the growth slows down a little bit, we can have the free cash flow yield go up a little bit to account for that. If we say that it's going to have a 3% free cash flow yield, which I believe is fairly realistic, that's a 15% return per year for Meta. So I think, again, this is a great company. When I look at Meta, I believe it's another high quality company that's currently dislocated from its fair value. It's not in the trash bin. Meta's not, this isn't a stock that's cratered that nobody wants to own, but I think it's a decent buy into a high quality company today. Next up, we have Adobe. Let's go ahead and take a look at this one. Adobe's now a company that a lot of investors are interested in, specifically because the company has sold down a lot in the past year. It's down 22% year to date, while the rest of the market's racing up. Adobe's stock price is going down. Now, most of the time when a high quality company has its stock price go down, it's because the fundamentals are eroding. But when we look at Adobe, we don't really see that in the numbers. Look at the past 10 years. Do you see strong fundamental erosion with their revenue growth? Well, the revenue is decelerating, and that's not something investors like to see. Anytime revenue decelerates from the premium category from like the 15% down to around the 10%, investors don't love that. So that is happening with Adobe. That's one point of concern. But we look at the other things and it just looks pretty good. Like Adobe still looks very strong. 13% growth in their total performance obligation. Net income grew by 30%. We have the free cash flow going up strong. When we look at this over the past 10 years, this is what it looks like. Free cash flow is growing by 12% over the past 2 years. Free cash flow per share growing 14% over the past 2 years. These are great numbers. When we look at the stock-based comp, they're also not a company that has out-of-control dilution. So why is a company today selling at a 6.7% yield? That's a super low valuation. Why is it selling at a staggering 14 forward PE ratio? That's an incredibly low PE ratio. Why is Adobe selling for this price? There's a whole list of concerns for Adobe, but I can boil it down to a few things. One of them is increased competition. On the bottom end of where Adobe competes with their Photoshop, you have companies like Canva, which are growing incredibly fast. They're growing at like 10 times the rate Adobe is. And Canva is an interesting company because it basically shares the same business model as a Duolingo or a Spotify. A company that has a freemium tier where you can just join and use it for free, and then they funnel you into the paid tier. So it's a very easy onboarding process for Canva. Many people are choosing to use it. They like it. It's web-based. You don't have to install a big platform like Adobe. It's very easy to sign up for. It's like signing up for a Netflix or a Spotify again. So it's super easy to use. It's super user-friendly. And a lot of people are turning to that instead of Adobe. And that poses a risk to Adobe long term. They may, in the end, start using Canva for even more complex things, even things that are applicable to companies and marketing teams. And that's already starting to happen. So you have Canva moving vertically up into Adobe's territory while getting a huge share of the low-end users. Then you also have generative AI. You have Nano Banana. You have, all these different AI generation tools that are making image editing easier. So that is a concern for Adobe long term. It's a concern of the overall moat. For example, when we look at Adobe today, we can assume on the cash flow basis that this company can grow their free cash flow by, let's say, 12% per year. And if it trades at a 5% free cash flow yield, these are very moderate assumptions. 12% free cash flow per share growth and a 5% yield, meaning that it's trading at 20 times free cash flow. Very cheap. 19% returns with these assumptions. So with Adobe, you don't have to make big assumptions. You don't have to believe that this company will grow like crazy. You just have to believe it will hang in there. It'll still continue to grow to some degree. Adobe's priced with so much bad sentiment that I believe the company is dramatically undervalued today, even with these strong bear cases. It's a company that investors just don't want to own. They're too concerned about AI, and that may be an opportunity for investors to buy it today. Now, those are three of the most popular. Let's go ahead and just take a look at the next one here. We have Amazon. With the free cash flow plummeting like it is today, it's difficult to even evaluate the company based on its current free cash flow yield. You'd have to assume growth rates of like 80%, 3% free cash flow yield just to get a 22% return, which could be realistic. Again, if Amazon turns this around, the free cash flow will go up likely 100% or 200% per year. So these are not unrealistic assumptions. If we look at the growth rate in earnings per share, you can do a little bit more moderation of growth rate here. I assume it will grow around 20%. I think the PE ratio for the company could be around a 28 PE ratio. That gives us about a 17% return. Amazon's in the dislocated category along with Mastercard and Meta. Next up, we have everyone's favorite, Duolingo. Duolingo is a stock that there's huge narratives around. People are trying to figure out if this company is going to even be around in 10 years. There's the thought that AI hurts the company. There's the thought that AI helps the company. It's one of these very big battleground stocks. The numbers today show a thriving and growing company by almost every metric. In fact, I think basically every metric. The monthly users, the active paid subscribers, the revenue, all of it's growing very quickly. So is the free cash flow per share. We look at the free cash flow per share, and that's growing by 48%. In fact, 49% year over year. So I look at Duolingo, and I think it's a stock that when you look at any of these charts, again, the cash, the earnings per share growth, all of that, it looks really good. It's the big question, similar to Adobe, of whether or not the AI tools and language learning tools and language live translation tools really will hurt this company. I've made a little bit of a bet. I've put this as a small portion of my portfolio that I think that live translation is not going to kill the urge for humans to learn new languages. And I also view Duolingo as more than just a language learning application. I view it as kind of like the Spotify of education. It's a company that's really getting everybody on planet Earth on board with learning new things digitally on their mobile application. Duolingo is not a company that you need to make huge assumptions for this one to work out. For example, if we plug in that it will grow its free cash flow per share by 20%, and we say it's going to be at a 3% yield, that gives us a 25% compounded return. But many people will say, well, the company's growth rate's going to slow down. It's not going to grow this quickly. So let's say that it grows at 15%. Even at 15%, we get a 20% return over the next 5 years. If we say that the free cash flow is going to grow at 10%, it'll have a 15% return. Overall, Duolingo is a company that I believe is in the fair valued category. This is a question of whether or not they get really disrupted or whether they just keep growing. If they keep growing, they will be fair valued today or even look undervalued today. Next up, we have Nvidia. If we look at Nvidia's growth rate over time, we can take a look at their free cash flow. This is what it looks like. Obviously, they went through a period of astronomically fast growth. The free cash flow per share is still growing at 38%, so it's still super fast, but it is decelerating. In the past 1 year, it grew at 38%. In the past 2 years, it grew at 111%. Let's say that it slows down to an 18% free cash flow per share growth rate. We get to a free cash flow yield. I'll put it at 2.5% for Nvidia. In that case, you still get a 10% return from today. Now, some investors will have much more bullish views on Nvidia. You can say, oh, it's going to grow at 25% for the next 5 years. That's great, but that is, I think, very, very unknown with a company like Nvidia. Maybe it will continue to get these huge deals. Maybe it won't. Maybe Google's TPUs will slow down their growth. Maybe it won't. It's very difficult to say. But with a lot of different assumptions, whether you think it's going to grow 15% to ranges of 25% or 30%, either way, you still get a positive return as long as Nvidia can maintain a half-decent multiple. So the company today, I think, I believe it's premium valued. Nvidia is not so overvalued that you can't get positive returns. It's just in a category where now investors, they've realized it. Nvidia is a huge company. It trades at a more premium valuation. You have to assume very healthy growth rates for the next 5 years. Salesforce, I don't even have to look at. This company's in the trash bin. The valuation is so ridiculous for this one. Investors like Adobe, just like Adobe, they're basically saying the it's disrupted. The growth is going to slow. It's going to be a slow treading water company. There's going to be picked away by 1,000 different competitors. And that has caused the valuation to plummet. So when I'm looking at Salesforce, I plug in very, I would say, conservative to bearish assumptions, and I get a 15% return. Even when I plug in a 13% free cash flow per share growth rate, a 4.5% yield, I still get a 15% return, even if the growth rate slows down to 10%. So 10%, if they can just get a 10% free cash flow per share growth rate, if the stock trades to a 4.5% yield, I get double-digit returns. That is a company that's pricing in a lot of doom and gloom. Salesforce is in the trash bin today. Will it be disrupted and the growth will be halted? That remains to be seen. After this, we have Google. This is one that we don't need to spend too much time on. Google's a company that I've already covered so much. I believe the company's still dislocated from its fair value. Now, this is a company that it's getting much closer to fairly valued. So it's worked its way up from the trash bin into the dislocated category. Now I'd say that it's somewhere in between these two. In fact, I don't know. It's hard to put this in one category or another. I think that Google is it's far away from the trash bin. It's a company that's now getting a better valuation. I might put this one in the fair valued category. But if I had a category in between these, I think it's fair valued to dislocated. The reason why is simple. When we look at a company like Google, it's easy to say that it's over, the story's over, but there's still story arcs playing out. Cloud growth is still massive for this company, still accelerating. The robotaxi story with Waymo is, I think, early on in the arc. YouTube is still a monster. You see Netflix and Paramount duking it out. Meanwhile, YouTube is they're just over there enjoying themselves, having the biggest market share of all. So Google has so many things that are still playing out. These aren't mature companies. These are fast-growing companies. Then in search, they have Gemini. So I look at it and I believe that this company is still a great story. We look at some simple assumptions here. I have it at a 14% earnings per share growth rate. I think a 31 PE. We still have above a 14% return over the next 5 years. So I like that. I like holding on to a stock that's great, has a great moat, and continues to grow. Next up, we get to Microsoft. Where does this one belong? We can plug in a few assumptions here. We can say that the company is going to grow its earnings per share, I think at 16%. I think Microsoft deserves to trade at an above 30 PE ratio. It's a company that historically always trades right at the low 30s. We get a 13% return if we do that. If Microsoft comes down to like the 27 multiples, and we get a 10% return. I'm going to put this one in the premium category. It's not a deal today, but I think Microsoft is still a worthy hold. Next up, we have Uber. We'll go ahead and take a look at this one. And this is another one that has some disruption risk, although investors have come to the conclusion that the disruption risk is not huge. There's still Waymo, but Uber's doing just fine. They're partnering with a lot of EV companies. They already have a big pipeline of it. And even Waymo itself is partnering with them. So there is a chance that like Tesla figures out their robotaxi with no employee. There's a chance that Waymo decides to never partner with Uber again, and that could hurt the stock. But overall, that's not really what's going on here. I think that Uber is going to be okay, and it's likely not going to be disrupted. When we look at the free cash flow per share growth, it's also very fast, growing 45%, but it is decelerating. When I look at the assumptions here, I think you can make some very conservative assumptions that it will grow around 25%. The free cash flow yield will always be a little bit higher for that disruption risk. If we put it at a 4.2, we get a 27% return from today. Very strong returns. If you want to take on the risk of that disruption potential, Uber is undervalued. I don't believe it's in the trash bin. It probably was at the beginning of this year, but I believe it's dislocated. It's a good company. There is some disruption risk, but it is dislocated from its fair value. More than likely, it's going to have a positive return. Next up, we have Netflix. This is one that's very difficult to do any realistic analysis on it today because a lot of it depends on what happens with this whole deal with Warner Bros. Are they going to be able to buy it? Does Paramount get it? We don't really know as of now. And I have a segment that I'll be covering more of that. But just to look at the current thoughts on it, what I'm thinking about this company, I look at it and it's trading at a 34 PE, 2% free cash flow yield. My assumptions of Netflix are very bullish overall. I really like what's going on with this company. I like their market position. I like their international. They have production companies like everywhere. They produce all over the world. Netflix is also a massive cash generation machine, producing over $10 billion in free cash flow. Next year, I think it will surpass $10 billion by a lot. I believe that their operating cash flow could be $30 billion in 2030. So this is a company that I have personally I think Netflix is one of the most valuable assets. And one of the reasons that I'm bullish on them owning, if they're able to close the deal, the reason that I'd like them to own HBO is because content is incredibly good at leverage. You can take a piece of content from HBO, slap it onto Netflix, and you get so much value out of that. So many people watch it and enjoy it that if they could dip into HBO's library, if they could really take that library, the ways that they could use that to enhance their overall service, they could cycle different shows all the time from HBO. They could make it so that Netflix always has their originals and their documentaries and all the stuff they create, plus some key HBO series on it all the time. And I think that leverage is incredible. The scalability of content is incredible. So I'd like it if the deal goes through, but there's a good chance it doesn't, especially because of how aggressive Paramount's being. So when we look at this, we can make assumptions today, but again, they're very difficult to make. We just don't know what's going to happen. I believe Netflix can grow its free cash flow per share at above 20% for the next 5 years. I think the company's super high quality and should be valued at closer to a 2 to 2.3% free cash flow yield. So I'm getting returns around 19%, around 20% per year for the next 5 years. With the current stock price dip, I view Netflix as an undervalued company. I still do. And that is a contrarian viewpoint. Most people do not. Most people look at the PE ratio and they go, it's at a 30 PE. Why is this company trading at such a high valuation? You have Morningstar and other analysts saying that this company's overvalued. They've been wrong on it before. I think they are again. I think they underestimate the operating leverage of content, how great content is at spreading, how good you can leverage content. And Netflix is a content machine. They want to acquire it. They want to build it. They want to create more content. They want to create entertainment worldwide. So we'll see what happens. I'll be discussing the news a little bit more, but right now I view Netflix as dislocated. All right, we have 3 more. We have Tesla, Palantir, and ASML. Let's go ahead and take a look at where these go. We'll start off with Tesla. Tesla's a company that's trading at a valuation, okay, a market cap of $1.4 trillion. $1.4 trillion. The amount of free cash flow it generated was less than Netflix. This company trades at 3 times the market cap of Netflix and generates half the free cash flow. This is a company that's trading with a lot of potential. There's a lot of people that believe in the vision of Elon Musk. They believe in humanoid robots. So they'll pay almost everything for that dream. But when I look at Tesla, I see a company where the vehicle deliveries are stagnating, where the revenue hasn't grown for multiple years now. I see a company where the robotaxi story is being taken over by Waymo as they continually expand, and Tesla doesn't have any robotaxi rides without an employee in the vehicle. Earnings per share have gone down. The tax credit was removed. And again, the company isn't able to beat their free cash flow numbers that they had back in 2022. So when I look at this company, I view it as one, it's just so difficult. Tesla is such a difficult one to get behind. You have to be fully bought into the vision to make any type of rational justification for its current market cap and size. And I'm just not that bought in. I don't disbelieve. I don't think there's no chance of it, but I think it's incredibly risky. Elon Musk has a habit of promising things and they don't happen for another 5 years. So this could be such a long process. This company could trade at this heightened valuation for a long period of time. Tesla grows its free cash flow per share by 25%. Even if you assume it trades at a decent, healthy valuation, like any other great company, like a Mastercard, at a 3% free cash flow yield, you get negative returns, minus 13% per year. What do we have to believe? Do we have to believe it grows at 40%? No, even if it grows at 40% per year for the next 5 years, you still get a negative return. You have to believe it's going to grow at 50% per year for 5 consecutive years to get a 40% or 4% return per year. You also have to believe that the free cash flow yield is so low, a 2% yield, just to get a 12% return. So much has to go right for Tesla to work out. This one is clearly in cult status. There's no offense. If you're in the Tesla cult, if you're a believer, that's fine. Just know that you're pricing in some hefty expectations. Next up, we have Palantir, a company that is also clearly in the cult status. I don't even need to look at the numbers, but we'll go ahead and look at them anyway. The valuation is so extreme that there's literally no precedence for them. There's no historical comparable. This one trades at a 106 price to sales. 100 times sales means that the company's trading 100 times their recognized revenue. So when we look at this, that's an incredible price to sales. Well, Palantir's growing really fast. It's growing at 47% year over year. The growth rate has accelerated. It's in the category of being the official AI company of 2025. It's really the one that everybody goes to for AI. So it's right in the right place at the right time. And it's really capitalized on this. The free cash flow per share has grown 73% over the past year, and it's actually maintaining that rate. Looking at this on a cash flow basis, let's go ahead and just plug in a few assumptions here. Let's say it grows at 50% free cash flow. Let's say it trades at a 2% free cash flow yield. When we look at these numbers, we get a 10.5% compounded return over the next 5 years. So that's a decent return, right? That might be in line with the market or market beating, but look at the assumptions we have to make. We have to believe it's going to grow by 50% over the next 5 years every single year. We have to believe that the multiple that it will trade at is a 50 times free cash flow multiple or a 2% free cash flow yield. That's very aggressive growth to get to a 10% return. Only the people that really want to have the most extreme high-flying stocks will have that in their portfolio. Finally, we get to ASML. ASML is at $1,100 per share. It has a moat that's the size of the Atlantic. I think this company's moat is enormous. It's incredibly difficult to ever replace what they're doing because they don't just have a software moat with actually running what ASML does, but it's like a scientific, real physics moat. Being able to accurately do what they do and being able to do it at scale with the throughput that they do it, no other company has come close. There's some science projects trying to figure out a way to replicate it, but the chances are very slim. And meanwhile, ASML continues to leapfrog their own advantages, pushing further into even better technology, making it more and more difficult every year for competitors to catch up. So the moat's very wide, but when we look at the valuation, it's also now priced at more of a realistic valuation. A 31 forward PE, 2.5% free cash flow yield. The company doesn't look super cheap today. When I look at ASML, I believe that it can continue on its growth rate of around 20% per year. I believe it's going to have premium free cash flow per share growth at around a 2.5% free cash flow yield, so around there. And I think that we get a 20% return over the next 5 years. Now, that's a bullish view on the company. We could see it trade up to a 3% free cash flow yield. We could see it grow 18%, but even then we get a 15% return. When I look at ASML, I certainly don't think it's dislocated. I don't think it's at the premium valuation. I'm going to put this one in the fair value today. But that is a look at the most popular stocks in the market and their corresponding valuation. I think it looks pretty good. Let me know what you think. Now, moving on, we turn our attention to some big news. One of the companies that we discussed earlier is Netflix. And Netflix is down today. And this isn't because of any stock performance issues or any company performance. This is on the news that Netflix already had agreed with Warner Brothers Discovery that they were going to buy part of the company, not the Discovery part, but they were going to buy the movie studio as well as the HBO part of it. So Netflix is going to run them separate. They're going to, use some tools like have some HBO content on Netflix, but overall keep the streaming services separate, and that way that they could grow together. Now, there was a lot of trepidation, a lot of people concerned about that deal already. After all, Netflix is already a huge streamer. They're the biggest one in the world. They don't really have a box office business, so they don't really compete with Warner Brothers, their box office. But there's also concerns that Netflix isn't friendly to the theatrical window, so people are concerned about that. They're concerned about market consolidation and power. And those concerns were very real. So investors were already concerned about this deal being able to pass. But the other prospect for owning Warner Brothers Discovery is Paramount. And Paramount may seem like a small company. It's only a $15 billion enterprise value, so it's much smaller than Netflix in market cap size. But the entities buying Paramount and owning Paramount and wanting to bid on Warner Brothers Discovery are much larger. They come from the Ellison family. Now, we know Larry Ellison owns Oracle. He owns 40% of the company, mega rich. His son, David Ellison, obviously has the Oracle family trust. So he's mega rich by default because of dad. And he's super ambitious, especially in this arena of owning media assets. He bought Skydance. From Skydance, he bought Paramount. And immediately after buying Paramount, he wasn't done writing checks. He wanted to write another massive check to buy Warner Brothers Discovery, the whole thing, cable assets included. If the deal went through for Paramount to buy Warner Brothers Discovery, the list of assets they would own in the media category is truly staggering. It's breathtakingly huge. I've made a tweet about this morning that's going viral, has over 4,600 likes and 800 retweets because it gives you a little bit of the depth of what would actually happen if Paramount's hostile takeover that they're trying to do right now is successful. If they win, Larry Ellison and his son will control TikTok because Oracle is going to be in control of TikTok in the US. They'll control Warner Brothers Studios, one of the biggest studios in the world. They'll control Paramount Pictures Studios, another one of the biggest movie studios in the world. They'll control CNN, CBS, all of HBO, the Paramount Plus streaming library. They'd also control almost every major cable channel. All the ones like the cooking channel or the food channel, all of the daytime shows, mini sports assets as well. They'd control all of it. Their grasp would be so big that they'd actually have a bigger distribution network than Disney immediately with the flash, with this one deal going through. So you can see why Larry Ellison and his son David Ellison are so keen on getting this deal through. They're going to do almost anything to make it so that they own Warner Brothers Discovery. Because if they do, they control media. They're the biggest media distribution company in the world, even bigger than Disney. If you don't factor in the parks, just the media distribution, they'd be bigger than Disney. Warner Brothers Discovery already had concerns doing the deal with Paramount for a couple different reasons. One of them was that the Warner Brothers Discovery executives said that Paramount's a small company trying to buy a big company. Look at the size difference. You have a company, Paramount, that's a $15 billion market cap, going to buy a company that's a $100 billion market cap. Well, that's very difficult to do. How does a company that's only $15 billion buy one that's orders of magnitude bigger than it already? So the small fish trying to eat the big fish problem is one of the concerns that Warner Brothers Discovery had. Another issue is the funding sources. Warner Brothers executives didn't like how this deal was proposed to be funded. Because Larry Ellison and his son David Ellison have a lot of money, they're going to be doing a lot of the funding themselves. So they're like the biggest buyer themselves, but they don't want to spend all of their money on this one deal. After all, it's like $100 billion to buy everything, which include 3 different Saudi Arabia funds. So they're going to the Saudis to get money to be included in this deal. And Warner Brothers Discovery was saying, you're going to get money from outside countries, different influences, to try to buy a unique content asset in the United States, a distribution channel. Is it good for the Saudis to have a stake in U.S. media, to control assets like CNN and CBS? That was one of the things that they thought was a little bit concerning. We don't necessarily want outside countries to own big stakes in U.S. media assets. So the Warner Brothers Discovery team was looking at this and saying, this very small company wants to buy our very big company. To fund it, they have to go to outside funding sources like Saudi Arabia and China. That doesn't look too good. Then you have Netflix. Netflix is a massive market cap company, $400 billion. They are financially very stable, very resilient. They have $10 billion in free cash flow. It's a company that also, surprisingly, even though it's bigger than Paramount, it has a lot less overlap than Paramount. For example, part of Warner Brothers Discovery asset, a big part of it, is their movie studio, the Warner Brothers Studio, where they make box office hits. Warner Brothers was the biggest box office company this year. So Warner Brothers is this massive box office studio, and Netflix doesn't really have any box office studio. So there's less overlap with the box office. Meanwhile, Paramount has Paramount Pictures, which is a massive box office studio. So there's also even less overlap with Netflix than there is with Paramount. So they viewed Netflix as being a good suitor, both with its financial stability and through regulatory pass-through. But either way, David Ellison is not done with this. He's very upset that they chose Netflix. He believes it's unfair. And now they're doing what's called a hostile takeover bid, where they're avoiding the management of Warner Brothers Discovery. They're going straight to the shareholders to do a shareholder vote. They have to get the majority of shareholders on board. So now we have David Ellison doing the public appearances, trying to get the shareholders on board so that they can have an overwhelming vote to sell to them, not to sell to Netflix.
So look, we're really here to finish what we started. Like, just to kind of take you through the road in terms of how we got here. On December 1st, we made an offer to acquire Warner Brothers Discovery to their board. Had a conversation with David Zaslav. He came back with a bunch of issues. We then on December 4th sent in a bid that addressed every single one of them that is superior to the bid that they signed up. Our offer is $30 a share, all cash, $41 billion in equity that's backstopped by the Ellison family and Redbird, $54 billion in debt with commitments from Citi, Bank of America, and Apollo. We have faster regulatory certainty to close, and our deal is pro-consumer, it's pro-creative talent, it's pro-competition, and we believe that when you actually, to further contextualize, that our $30 in cash, $30 a share, is basically $17.6 billion in cash more than the $23 in share that they signed up.
So he keeps mentioning that they're bidding more than Netflix, but that's not entirely accurate because Netflix's bid, although less than Paramount's, doesn't include the entire company. Netflix isn't bidding to buy CNN or Discovery. So he's not really mentioning that their bid is more, but they're buying the entire company, not just part of it. Depending on how much you think the other assets are worth, there's many estimates that Netflix's bid is higher than Paramount's. But that's up for debate. It really depends on how much the other assets are worth. Another thing that he always mentions over and over again is our bid is all cash, as opposed to Netflix's bid, which is in part by stock, now a small portion of it. But I don't believe that's a huge benefit. Netflix's stock is very valuable. I have a very bullish view on it. I think it's worth more than cash. So if I was a shareholder of Warner Brothers Discovery, I would want it to be transferred into Netflix stock. Netflix stock is incredibly valuable, especially if the deal went through, it would become even more valuable. So if you're an investor in Warner Brothers Discovery, you want the deal to go through with Netflix because you would get Netflix stock, and that would mean the deal went through, which would make Netflix's stock more valuable. So there's a lot that he leaves out with this, but in any case, he's going on TV arguing his argument, which I think he wants to do to convince shareholders to go with him, not with Netflix. If the deal goes through, if it doesn't go through, I'm still going to own Netflix stock. I still think that they have great management. I think that they have such a great product. I think they're internationally diversified. Yes, it would be great if they could tap in to the HBO library, if they could use those assets and spread it across their massive subscriber base. That is a huge amount of leverage. So it'd be great if this went through. If it doesn't go through, they face a big competitor with Paramount. But I believe there's so much content to go around. I think that this is such a good industry to be in that I view all of it very positively, and I'm still going to be invested in Netflix. Now, moving on, we get into this week's fail of the week. We have the story. This is from the New York Times of Kitkat. And we're not talking about the candy bar. We're talking about the cat. How Kitkat was killed. Video shows what a robot taxi couldn't see. So we have this very dramatic write-up from the New York Times. Now, it has a video here, and we have the actual footage. I'm not going to show it because it shows a cat getting run over, unfortunately, by a car, which is very sad. I'll admit, as someone that I love animals, I really do. Like, I like almost every animal. I have a dog. I have a golden doodle, a big, fluffy animal that I love. And I do like cats a lot as well. I actually really like cats. And it is incredibly sad to see any animal ever get hurt or ran over. Hopefully it can be avoided. Now, I'm not going to show the video because I don't want to show that on the channel, but I'll just describe just briefly what happened. We have the Waymo right here. It's parked picking up a passenger. This looks like it's in the PM hours at night. And then we have Kitkat right there. Kitkat, while the Waymo's parked, this cat runs and darts right underneath the vehicle, in front of the front tire, but then it goes underneath it somewhere, right underneath the Waymo. The Waymo can't see it because it doesn't have any LiDAR or sensors directly underneath the car. So the Waymo pulls away, and while it's pulling away, one of the tires hits the cat. The cat succumbs to the injuries. Now, normally when a cat gets ran over, which happens somewhat frequently, right? There's lots of cats and lots of cars. It's something that unfortunately does happen. It doesn't make a lot of news, but in this case, it did make the news. It made the New York Times because this cat wasn't run over by a human. In fact, it was run over by a robo-taxi. So therefore, it's more newsworthy. We have here an in-depth report, and this is where we get into the fail. This is an in-depth report and biography of the cat. How meaningful the cat was to different people. Kitkat's death has sparked debate over how safe autonomous vehicles are. On October 27th, the death of Kitkat, the bodega pet so familiar that neighborhood residents called him the mayor of 16th Street, made international headlines. Now this cat's death is making international headlines. The episode started a heated debate between those who despise automation and those who believe robots can improve their everyday lives. Those who defend Waymo taxis have pointed out that human drivers kill hundreds of animals every year in San Francisco. So just in that one city, not across Earth, but in that one city, San Francisco, humans are running over cats all the time. It's like a daily occurrence. It's very sad. Again, I wish it was avoided. I really do like cats a lot, but this is just a reality. That's something that happens every single day. So I think that is worthy of pointing out when you're talking about the risks of a Waymo. If it did one thing that a human driver does every single day, that is something worth pointing out. I've seen the video, and there is no chance a human would have seen a cat go underneath the vehicle. Regardless, now in San Francisco, there's big vigils for the cat. It's made international headlines. A lot of people are using it to attack Waymo vehicles. After the accident, we were overwhelmed by a media frenzy that decided not to release the video. However, after discussing it with members of our community, there is a need to raise awareness about enhanced technology, including the possibility of integration of sensors underneath the cars to detect living beings. So now they're calling upon Waymos to have even more cameras, some of them directly under the vehicles, to negate the chance of this ever happening again. Now, again, I just want to point something out here. Humans have been running over cats for years. It happens every single day. Cats get under vehicles, they go underneath them, or whatever may happen. A person runs over them. I haven't seen many calls for people to have their cars have cameras underneath them, a huge expense, to save cats. But as soon as a Waymo does it, as soon as one Waymo runs over one cat one time, now all of a sudden there's calls to have cameras and sensors underneath the vehicles. Now, I'm not even saying that this shouldn't be a thing. Maybe we should have sensors under vehicles as well, but why did we wait until a Waymo did it? Why hasn't this been an issue before? Humans have been much bigger offenders of this exact issue than robots. Now, in fairness to the New York Times, they do outline that humans are much worse drivers on every measurable statistic that you can put together, including killing animals. Human drivers kill hundreds of animals and dozens of people every year in San Francisco. They drink alcohol, they text, they have medical crises. A Waymo research paper, which has been peer-reviewed, shows that robot taxis are safer and result in far fewer crashes. They're so much safer, it's so medically significant how much safer a Waymo is, that it would change our entire medical history if they were widespread. It'd make it so that one of the biggest ways people get injured, spinal injuries, or get killed is completely erased. But regardless of all of that data, the death of Kitkat has caused public outrage. On social media now, we have people making it like their thing to stand up with Kitkat and go after the big bad company Waymo. We have right here Jackie Fielder, a representative from California. This is an elected official now saying that she's going to make this a big thing. Listen to this big post she made on social media.
If I were the Waymo PR team, I would be hoping that this whole Kitkat thing just dies. And that's not happening. Tomorrow we'll be holding a press conference at Ronders Market, Tuesday, November 4th at noon. Please come if you're able. My name is Jackie Fielder. I represent the mission on the San Francisco.
She's holding a press conference, a legitimate press conference, an elected official over a cat that was run over. Again, it's sad that the cat was run over, but people get killed by cars every single day. Hundreds of people. And the whole video, by the time you watch this video where they're going to have a press conference for this cat, somebody likely got struck by a vehicle, a pedestrian, and died from a human driver. But now we're holding press conferences for cats. And she continues on here.
Come if you're able. My name is Jackie Fielder. I represent the mission on the San Francisco Board of Supervisors. The mission is where our beloved Kitkat called home. I live around the corner from Ronders Market, where she was tragically killed by a Waymo. Last week, I posted about how the Waymo CEO said that society will accept a murder by a Waymo. And since the fatal hit and run...
Do you see what she just did there? This is the go-to strategy of elected officials, many of them. She just said the Waymo CEO, and this is again Jackie Fielder, she says the Waymo CEO says that society will accept the murder by a robotaxi. The murder. Let's go ahead and just listen to it again. That's her exact wording.
Said that society will accept a murder by a Waymo.
That society's going to accept if Waymo murders you. That's what the CEO of Waymo apparently said, according to this very, very good source, which is a elected official. The Waymo CEO never said that society's going to accept Waymo murdering people. Never said anything close to it. The Waymo CEO said that Waymos eventually will be in an accident that causes a death. And society will accept that as long as those accidents are much fewer and there's much fewer deaths per capita from Waymo drivers than there is from humans. If there's an order of magnitude fewer deaths from Waymos, then it's much safer than human drivers. Nowhere did the CEO ever mention murder. Murder is the intentional killing of someone else. And this is the type of word games that these people play. Completely misquote, not just misrepresent, but entirely make up things that other people are saying. Even the article that she posts here, the headline, society will accept a death caused by a robotaxi. That's very different than a murder. But you get these people. Again, this is California elected official here.
The Waymo CEO said that society will accept a murder by a Waymo. And since the fatal hit and run of Kitkat, Waymo has confirmed that one of its self-driving cars indeed killed Kitkat. And Waymo tried to say that the cat jumped in front of the car.
If we pause it here, again, the text that she puts up on the screen and what Waymo actually said is entirely different than what she says Waymo says. So it says right here, and this is quoting Waymo, We reviewed this, and while vehicle was stopped to pick up a passenger, a nearby cat darted under the vehicle as it was pulling away. That's exactly what happened. That could not be any more truthful. You can watch the video yourself. But she again misquotes Waymo, saying that they said something they never said. I would play the rest of this, but it goes on for another 2 minutes, relaying the entire story from her completely made up perspective. To go along with her narration that Waymo's now okay murdering people, the arguments that she's making are completely detached from reality. Now, again, I will mention I like cats a lot. I actually really like cats. So it's unfortunate that this Kitkat died. That is unfortunate. But this is crazy. This is crazy. This is a crazy reaction to an event. Right now, there is real human suffering on a scale that is almost incomprehensible. Today, on average, 100 people will die from cars caused by human drivers, much of it avoidable. The statistics for Waymo are so much better. On average, they reduce deaths and fatalities by 91%. The medical significance of that is incredible. It's something that we should be celebrating. And even when it comes to animals, Waymo has many videos where they swerve out of the way for animals where humans would never be able to do that. On net, they're likely saving more animals' lives by far than they have these unfortunate incidents like this one. But this is the standard and the challenge of a robotaxi. Anytime a Waymo does anything that's wrong, anything that's a little bit off, anything where they hurt someone or something, even if a human does it on a regular basis, does it to a much bigger extent, the Waymo is going to be looked at with 100 times the scrutiny. And this is the challenge with this type of business expanding. We have investigative journalism and video investigations from the New York Times to cover the death of this cat only because it was killed by a robotaxi. Had it been killed by a human, you would have never heard about it. And that is why it is the fail of the week. That's all for this episode. Hope you enjoyed. See you in the next one.